The first part of this webinar is related to profit taking. And I want to present two strategies for profit taking. And that's the educational piece for this week. Now, I'm going to extract those two strategies from a document that I actually wrote and distribute to the subscribers to my Signal service. It's an how-to guide, and in the document I speak about how you take advantage of the service and how the signals are presented and so on. Last week I presented 3 strategies to enter, and this week I want to focus on profit taking and moving stops. I don't know if you can see this. I'll try to make this a little bit bigger here. Allow you to read here. We're not going to read all this. I'm just going to show you what are the two main ideas here. As you know, as you might know, I'm a fan of using risk-free levels and risk-free trading. Now, I explained risk-free trading last week, but I'll be I'll do a recap, very quick recap about what risk-free trading is and how we calculate the risk-free level. And the risk-free level is involved in the first strategy. As I mentioned, we're going to review 2 strategies here. The first one is the risk-free level strategy, is the strategy number 1, and the second one is basically taking profits, never taking partial profits out, at least until we get to the first target. Now, my trades typically can have 1 or 2 targets. So, and that really depends on a number of factors, including how the market is moving, the current market conditions. And occasionally, the second target will be considered when market conditions warrant extended moves and the probability for the market to move to the second target, it's actually higher. So when we look at these 2 strategies, and as I mentioned before, to introduce the first strategy, I need to talk a little bit about risk-free trades. When I speak about risk-free, doesn't mean that we can remove risk from trading. Okay, that's impossible. However, although trading risk cannot be eliminated, and we have to consider trading as a business, risk can be removed if price behave in a certain way. Okay, so if price moves in the direction of the trade early enough during the trade lifetime, and here I want to show an idea of what that risk-free trade is. Now, in this simple example here, I'm showing 2 lines. They represent very schematically, very simply, the entry level, or the start of the entry area, I should say, and the stop level. And it's also, for me, the stop level in the method I use is also the level where I'm not going to look at the opportunity any longer. So these areas as an importance for me, but what I want to introduce now is the concept of risk-free trading. Let's say that we enter right at the entry level, okay, right at that level, and we place a stop, an hard stop at our stop level here. When we do that, we are carrying a risk, a pip risk, a dollar risk, can also be expressed in dollars, of course, which is related to the percentage of our capital we risk. We can risk 1% or more, depending on, again, on your money management technique, which we're not going to discuss here. Now, if we carry this risk, and again, they can be expressed in dollars or in pip or ticks, there is a specific level, unique level that is identified in our trade, and it's the level where our trade is going to show gains that match the initial risk. okay? So this level is unique, and it's calculated very simply. Setting aside any spread and any other consideration, this distance D in pip, if we add it to our entry level E, then we get a risk-free level, which is basically the distance between E and S above E. Okay. Now this level here is unique, and I call it the risk-free level. Why risk-free? Because if we behave in a certain way when price gets into this level, so it goes in our advantage and enters and gets into this level, then we can generate what I call a risk-free trade, or conditions to be risk-free. How do we become risk-free? Well, if this market goes into the area where we get involved and then moves quickly into this level, and we remove 50% of the position when we are here, right? We take half unit of risk, equivalent of half unit of risk in gains, we take it out from the market. Now, when that happens, this trade becomes risk-free, because whatever the market does next, right, it's not really important. And there are two outcomes that can happen. Either the market gets to our first target, or the market is going to stop us out, right? Maybe coming back here and then stops us out. So if the market actually stops us out, and this is then, I'm going to elaborate on strategy 1 here. If the market stops us out, and so the market does something like this, so it goes into that first target and then it comes back and stops us out, we took 50% out of the position here, so 1/2 of the initial risk in dollars or in pip was taken out of the market. If the market comes back into the stop loss, we then lose 50% of our initial position, which was, a half of risk. In this case, as you can see, we take something out of the market, we lose that same amount of pip dollar when and if the market hits the stop, and so we end up basically with nothing. Of course, we will have some costs. Those are the cost of doing business. Those are the transaction costs, spread cost, liquidity, and so on. So, but generally, the cost of this trade, if you're stopped out, is going to be very, very small, near to break even. Okay, why is this strategy important of profit taking? And what is the actual strategy? Supposing that we have a risk-free level here, as is shown here, and we have a first target somewhere higher, let's say this is going to be our first target, then this strategy allows us, this profit-taking strategy, it's very, very specific. We take 50% of the position out of the market at the risk-free level, and then we basically take the other 50% out, so closing the position if the market gets into the first target, or we actually take it out if the market actually gets into the stop. So as we mentioned, if the market does this, we basically close at break even. But if the market does this, then we close with a gain, and our gain can be calculated as the initial reward to risk that we had plus 1 divided by 2. And this is going to be our new, I call it adjusted reward to risk that we have if the market behaves like here in case 2. So there are two cases. So why this profit-taking strategy is actually important, because by taking out of the half of the position out when the market gets to the risk-free level, we can let this market move as it wants. So if you have psychological problems or related to trading, of course, or discipline issues, then although this strategy returns a small reward to risk compared to what you could get out of the market if you were not choosing this strategy, this strategy actually helps you developing the right beliefs and the right behavior in relation to the market. In fact, the right behavior in relation to the market is to never move the stop higher, or certainly not during the early stages of a trade. A lot of people like to do this whenever they get a fill. They actually move the stop higher. So what they do, they had initially the stop here, and they move it at entry. So they now move the stop here. However, when you do that, you don't leave the market the possibility to keep moving and do whatever the market has to do, which includes getting back into the entry area. In fact, you will see that a lot when a valid 50% level in the FibStalker methods or any other area that you use to enter your markets is actually tested. Very often you will see a market that moves laterally and can retest the level a number of times. Okay, and this concept of raising the stop, it's a little bit, I believe it's son of strategies that leverage volatility or breakout kind of strategies, whereas we already see price moving in the direction of the trade. However, we also have to remember that any time we have such a price behavior that that we have position that leverage somehow breakouts, those positions are also very, very close to their first target as well. So we are interested in taking advantage of price around levels where price reverses, rather than taking advantage of price when there is a breakout from a previous consolidation. Why? Because when that happens, price is very, very close to this first target. So generally that means that the reward to risk are lower, but most importantly, the risk in the trade is higher. See, very often what happens is that when such a breakout takes place, the market has already set up around these areas of participation of algorithms. And not only, it has also touched the risk-free level that allows us to become risk-free. Okay. So the importance of using the risk-free level is that it helps you build the right behavior and also beliefs about trading. And central and very important belief is that you let price move and you never raise or change or lower, in case of shorts, your stops. Okay, so this is one strategy you can use. So the main disadvantage of this strategy is that basically you have lower reward to risk, because you have an adjusted reward to risk, and the formula, it's very simple, equals the initial reward to risk you would have in this trade plus 1 divided by 2. So the fact that you're dividing your initial reward to risk, that you want to be probably bigger than 3 or bigger or equal entry, then you're obviously reducing your adjusted reward to risk with this strategy. However, you're building consistency and you're building the right beliefs when you use these strategies. The detractor of these strategies usually tell me, well, you're taking the highest risk at the very beginning. You are risking here 1 unit of risk when we enter. And then when the market is finally moving in your direction, you then remove half of your position. And I say yes, and I do that gladly if that helps me. I understand that. And I do that gladly if it helps me to reduce the risk in my trade. And most importantly, it helps me to stay with the trade and never, ever change the stop. This is so important. In fact, if you study different methods of entering into the market, you will recognize and you will see yourself that moving the stop always reduces the reliability of the trade and the possibility for the market to get into first target. All right. So this was strategy 1. When we go back to the document here, there is a simpler, another strategy, which is just to not consider the risk-free level, not even calculate it, and just keeping the position as is, of course, without changing a stop, without hiring or lowering the stop for shorts, and just take the full position out at the first or second target occasionally, if market conditions warrant a larger move in the direction of the trade. Okay, so for now, I'll just make reference to the first target because I want to show a concept here. So then. Strategy 2 really it's something even simpler here, and we have strategy 2. We have the same situation here, whereas, and again, this is I'm now talking about strategy 2 here, and the concept here is slightly different. First of all, in strategy 2, we do not consider the risk-free level. We behave like that level was not there. We don't know about this level. We don't choose it. And what we do basically is just whenever there is an entry or an entry signal, we enter into the trade, and what we do, we just let the market move and do whatever it has to do. Even if it comes very, very close to the stop, we will just keep the full risk without doing anything. Okay, and in this case, then what we can anticipate, as usual, there are 2 outcomes, and the first outcome, of course, is that we are stopped out. And that's the first outcome. We enter the market, might even go in our direction, but eventually what happens is that it stops us out, or the market can actually continue higher and eventually get into that first target. Okay, and this is outcome 2. So there are always 2 outcomes in the market. In order to not interfere with your position and what the market is doing and what price is doing, the best thing to do is to be able to accept risk. Okay, if you risk 1 unit of risk, which could be, for example, let's say it's 1% in your case, well, you have to fully accept the fact that you can lose that 1%. Now, 1% is not a big deal, but I know a lot of traders, especially starting traders, who believe that they can conquer the market with discretionary decisions, and they risk way more than 1%. In fact, there are people who risk 10 to 20% without even realizing it. And how do they do that? Well, basically, they take decisions based on a number of discretionary conditions or decisions, and they really never consider the fact that the market could actually go well against them. So they never entertain the fact that the market can move 20% against them. And the problem is that when and if that happens, then they're in big trouble because they never accepted the possibility that the market could do something like that. And so I often talk about risk acceptance, because whenever you put on a trade that has and you know where your stop is, and you'll be surprised that I remember in 2014 I was in a meeting with the North American responsible for sales at a.k.a. Here in Toronto. That was 2014, and this person was actually talking about aggregated figures they had on traders' behavior. Of course, they can only provide aggregated figures, and 22% of traders at that point with a.k.a. they didn't have a stop, and obviously that resulted in getting margin calls all the times. So there is at least 1 out of 5 players in average in the markets who do not even know the concept of stop, and probably they know very little about risk management. So that to say that you shouldn't be surprised to meet people who believe they can play the market and don't even know how much they are risking. And in fact, very often I spoke to starting traders who had position and also had discrete success, but to the question, how much are you risking? What's your risk? They could not answer that question. Okay. Now, if you want to use strategy 2, obviously you know how much you're risking, and for some of you this is obviously basic, and if you enter around this area, you're risking 1 unit of risk, whatever it means for you in terms of dollars, or pip risk or tick risk for your market. For example, you could be trading futures on Forex or SP 500 E-mini, or futures on gold and silver. You could be trading stocks as well, because these methods work for stocks. The point I want to make here is that whatever you risk, you have to accept that risk. And in a risk-free trade, you exit half of the position when you get into that level that equal your risk. In the strategy 2, you just keep it till you get to the first target, which means that you have to accept any outcome of the market. And one of the outcomes is always that you lose your unit of risk. The other one is that you realize your initial reward to risk ratio. And talking about reward to risk ratio, in this strategy 2, which is the strategy where you don't take profits at the risk-free level, one advantage is that typically reward to risks are higher, and you realize the full potential of this trade. If the initial reward to risk is 3 or 4, that's what you make. You risk, let's say, 1%, and you can make 3 to 4% on this trade. Okay, so that's the advantage. The disadvantage is that if your entry area is smart enough that very often allows you to move price into that risk-free level very often, then by actually not using the risk-free level profit-taking strategy, then you are putting yourself at a higher risk, and the higher risk is that you lose 1 unit of risk. Now, this is part of doing trading. Is the cost part of, let's say, this is the cost of trading. It's the cost of doing business, and you have obviously to accept this. You also have to make sure, though, that you take your positions in areas that are proven to be to work in terms of quickly generating gains or quickly putting the position in your favor. If you do that, you still have you can still have the option of deciding to use the risk-free level, because that reduces the reward to risk, but basically makes very often your trades risk-free. And if you have problems sleeping, if you feel the pressure of having money on the market, there are two things that you have to consider. First of all, whether you could benefit from using a risk-free approach. Second is, and this is the most important question, is, are you accepting your risk? Because, see, if you're not accepting your risk of losing 1 unit of risk, whatever that is, it means that that unit of risk is too high, and maybe you have to work a little bit to reduce that. Okay, so there are always different ways you can work on your psychological response to trading, as well as on your discipline. And I gave you a few ideas in this educational section here. So if you have any questions, you can I can answer them now, or you can actually send me an email, FibStalker@gmail.com. Now, as you know, in my models, I use smart money, which is which actually models modern algorithms. I should say a class of modern algorithms that is derived from program trading of the 80s. And I also look at how dump money behaves. And what I have synthesized and identified with my studies is that smart money initiates and leads moves in the market, while dump money obstacles price and follows. So dump money is reactionary, while smart money is actually proactive. Now, I truly believe that in order to win in the trading game, we need to start the smart money because of the nature of how they can actually affect price and the fact that they initiate and lead price development. Okay, now, so you can learn to recognize these two groups in a number of ways if you like, and one is to join my FibStalker trading signal service. You can do that at winningwithalgos.com signals. Have a look at that. You can also learn more about smart money, which leads, initiates, and leads moves. And I have a free trading course of 6 hours at winningwithalgos.com/start. And if you are really serious and you want to learn how both of them affect price, then consider joining my FibStalker Methods coaching program. All right. So, and this concludes this section of the webinar, and this was the educational section on the 2 strategies to enter to take profits in modern market. Thanks for watching.